Good afternoon and welcome, everyone. I'm Helena Walsh, Managing Partner at Agendi, and it's a pleasure to have you with us for this webinar. As you're aware, today's session is a practical deep dive into UK Sustainability Reporting Standards, specifically focusing on S2, and that's the climate-related disclosures. For the next 45 minutes, we'll be covering what is required, how it compares with current reporting expectations, and then mainly focusing on what implementation looks like in practice. Today, I am joined by one of Agendi's senior consultants, Yin Mui, and we are also delighted to bring in the technology and implementation perspective through Nossa Data. And Julianne will be sharing a gap analysis perspective, but I'll leave those details for her to introduce shortly. A quick note before we begin, we are recording this session. We certainly welcome questions throughout. There's a Q&A box. We'll, of course, share the slides, the recording, and any questions that we don't get to in the next 45 minutes, we'll gladly follow up offline. So do keep your questions rolling. We'll take a look at the chat. We'll see what we can answer directly. Otherwise, postpone those to the end. Before we begin, a very quick note on Agendi. We are a specialist climate and sustainability consulting firm, and we serve large global organizations across sectors, and our work spans the full sustainability agenda, but always with a strong focus on practical implementation and decision useful outcomes. And of course, increasingly, our work supports preparation and response to sustainability disclosures, particularly where those need to stand up to investor scrutiny, internal governance review, and then the growing regulatory expectations, which of course is our focus for the topic today. So I'll hand over to Julianne briefly to introduce Nossa Data. We've got our content interspersed across the deck in the next 45 minutes.
Hi, I'm Julianne. I'm co-founder and CEO of Nossa Data. So we are an external reporting platform, and our aim is to streamline sustainability reporting via a single tool. We're specialized specifically in the listed market, considering things like your regulatory disclosure, UK SRS, the topic of today, but also things like CSRD, as well as the breadth of voluntary disclosure a lot of you are familiar with, from EcoVadis to CDP to the ESG rating agencies. We integrate AI with the disclosure process. So today I'll be going into how you could actually use AI to streamline a lot of your UK SRS preparation process. We classify topics thematically so you can be clear, and we help you assign, track, review everything within a single tool. So it's great to be connected with everyone today.
Brilliant. Thank you so much, Julianne. And in terms of what we will cover today, our session fits into four main parts. First, I'll do a very quick recap and overview of the UK SRS, but then our focus for the webinar will be on the implementation roadmap. We'll be looking at gaps, what's required in terms of the extension of climate scenario analysis, and of course, best practices to meet disclosure requirements. And then, as I said earlier, we'll close with takeaways and Q&A. Lovely. So starting off with a very quick recap of UK SRS, and I'm sure everyone is probably very aware that the UK SRS is adopted from the overarching standards of the ISSB. The ISSB standards are a response to the complexity we've seen over recent years across ESG reporting frameworks as we shift to, thankfully, a more consistent global baseline. And the UK is one of over 36 jurisdictions, and that represents around 60% of global GDP that have either adopted ISSB standards or they're aligned through frameworks like CSRD, or they're actively progressing towards adoption. And this shift signals a very clear convergence to, thankfully, a single investor-focused approach to sustainability and climate-related financial disclosures, and certainly welcomed, especially across clients where they fall under many jurisdictions of these requirements. And in terms of the adoption timeline for the UK on the ISSB, this has followed a very steady pathway of technical reviews, calls for evidence, technical advisory committees, endorsement work, etc., leading all the way up to the key documents of the FCA consultation for listed company application, as you're probably aware, that closed just recently on the 20th of March. And we also have the finalised first two standards of the UK SRS, and those were released in February this year. At the very highest level, as I said, the UK SRS is built directly from the ISSB standards. So IFRS S1 becomes UK SRS S2. And then, of course, when we move on to the climate disclosures, we have IFRS S2 becoming the UK SRS S2. S1 covers the general sustainability related financial disclosures. So this is kind of a broader framework of sustainability risks, opportunities, including the need for a financial materiality assessment, and most importantly, the connectivity to financial performance. S2 focuses specifically on climate-related risks and opportunities. And that is, of course, when we think about the current disclosure requirements in place for climate, we're moving towards stronger expectations around climate scenario analysis and the integration of climate matters into forward-looking financial planning. The timeline you can see on the right was taken out of the current proposal for adoption for listed companies as part of the FCA consultation that just closed. And of course, our focus within this webinar is on S2, so the climate-related disclosures. And what we can see is that they are set and proposed to replace current climate-related financial disclosures, that's the CFD, and be mandatory from 2027. And of course, we have the exception of an optional one-year relief on Scope 3 emissions disclosure. S1 has an optional 2-year relief, and it's proposed for application on a comply or explain basis. Although we are focusing on S2 within this webinar, do keep in mind that some of the overarching context setting, time horizons, key decisions are detailed within S1. So we do recommend that these are still considered in unison, even if you are going to make use of those transition reliefs. And visually, this can be detailed as showing S2 essentially sitting under S1. So S1, as I said, the general sustainability disclosures provides the overarching framework, establishes the core concepts, reporting architecture, and as I said, the connectivity to financial statements. It essentially governs how sustainability risks and opportunities are identified, assessed, disclosed, and then linked to your business. So S2 takes that same architecture and applies it specifically to climate issues. S2 inherits the same 4-pillar structure, so governance, strategy, risk management, metrics, and targets, but then adds on climate-specific requirements. And of course, that's looking at scenario analysis, expectations, as well as emissions disclosure and relevant industry-based metrics. Do keep in mind that over time, this architecture is likely to expand as the UK considers future ISSB-aligned areas. Of course, within the ISSB, we have within draft planning our nature and human capital standards. And then do keep in mind that any adoption of these additional standards is expected to pass through the same technical review and adoption process that we saw for the first two standards. So the climate standard is the more immediate, but the reporting model will remain broad and is expected to expand over time. Now, with that structure in mind, I'll quickly compare the UK SRS S2 to our current climate-related financial disclosure requirements. And then, of course, we'll shift on to the implementation piece after. So broadly speaking, the key summary is what we're expecting out of UK SRS 2 is a step up from our current disclosure expectations. There's greater emphasis on formal governance, accountability, expectations around more robust scenario analysis and resilience assessment, moving towards financial quantification. There's also the expectation around a deeper integration into enterprise risk management and a significant uplift in metrics disclosure. particularly around Scope 3 and target tracking, although do keep in mind there is the 1-year optional relief on Scope 3. So the shift overall is towards more rigorous, financially connected, and transparent disclosures. And lovely. I think that concludes the intro, and we'll move on to what that means in practice. So as I said, our main section of the webinar is really focusing on what this looks like in practice and deep diving into these implementation steps. So we'll be following this roadmap across these 5. They're quite simplified and not necessarily running sequentially, but for the purposes of this webinar, we'll have them running sequentially. These 5 steps will cover these across the next section. So step 1 is looking at the scoping, the gap analysis, the maturity mapping. When we move on to step 2, we're looking at the risk and opportunity assessment, focusing from a financial materiality perspective. And then, of course, digging, Yunmuri will cover this piece and she'll dig deeper into those enhanced expectations around financial quantification. Then, of course, we have governance, stakeholder engagement, wrapping all of that up in terms of data, reporting, controls, and thinking about what that looks like in the future for continuous improvement and future planning. So I'll hand on to Julianne here, who will detail how NOSA supports in terms of the scoping and gap analysis.
Thanks so much, Helena. So in terms of how can you actually start with a gap analysis, we felt that the most effective way to explain this is through a hypothetical example with the company BAT. One thing to consider under UK SRS and IFRS S1 and S2 in general is there's a lot of lessons we can learn from what's been happening with CSRD in Europe. So for most CSRD companies, they started by considering the regulation at a data point level, so specifically thinking through each data point one by one. That's a really helpful way to think about it as an issuer because regulatory text can be quite heavy and there are a lot of sub requirements that you need to consider. At the same time, AI is advancing more than ever before. So almost by the day, AI can do more of the work for you in terms of mapping, understanding what needs to be done. So let's take this case. Every single company has a starting point in terms of what they've already disclosed and been doing along climate. You can take your company's current universe of existing documents, whether that's your annual report, sustainability report, a policy, a transition plan, a CDP response. You can also make advantage of private documents with going through this. From a software perspective, we try to combine actual software in terms of reading and processing that information with ESG expertise. So in the case of NOSA Data, we think about UK SRS again at that data point level, considering the best practice that you've learned from companies preparing under CSRD. And the tech can process the data versus the requirements. From an outcome, what you can get at that first step is you can say, from a UK SRS data point perspective, how does your current disclosure meet or not meet the different UK SRS requirements? If you just go to the next slide, I'll then show an example. So what we did with BAT is we looked at 4 public pieces of disclosure that they have. This is around 1,000 to 1,500 pages of disclosure that they've already published and been putting out on the market. And then we process that information against each sub-data requirements. So in the IFRS S2, which governance body are responsible for the oversight of climate-related risk opportunities? Then the next sub-data point might describe how the governance body's responsibility for climate-related risks are reflected in terms of reference, mandates, and descriptions. So we tackle that one by one, and we align their existing universe of data versus that sub-requirement. If you just go to the next slide, please. From there, what can you actually get as an outcome and as a starting point as a company? One, AI can help you pull quotes and references from your existing disclosure suite versus that disclosure requirement. So here you can see examples were pulled from their annual report, from their CDP response, from their transition plan. It can then categorize it. So in the case of BAT, it categorized is, yes, they have some data, but it is an incomplete data set. So it does not believe that they're fully at the UK SRS requirements. And then it will actually explain from the company perspective. So again, this is all happening very, very quickly. Why is the data that BAT is currently publishing, is that not meeting the methodology requirements? So it'll go specifically that it does limited disclosure on governance bodies' trade-offs in decision-making and how climate-related performance is linked to remuneration. So again, all of this can happen in a very, very granular basis very quickly. So your starting point can be there from there. I'll let the Agendi team continue into the next phase of implementation.
Thanks, Julian. So after gap analysis, another core component is really looking at the risk and opportunity assessment and scenario analysis piece. So for many organizations, this is where things may feel the most complex, and it's also where we will spend the most time in today's webinar on. We start with a quick introduction before moving on into what the UK SRS actually requires. In terms of climate scenario analysis, you can think of it as a structured way of exploring how an entity may perform under different possible future states of the world. So different scenarios emphasize different risks, with higher emission scenarios typically highlighting physical risks, so aligned with IPCC states, while lower emission scenarios bring stronger transition risks, so policy, technology, market shifts, commonly based on IEA or NGFS scenarios. A strong analysis should really consider both your high and low emission scenarios. So asking what physical risks may arise, where they may impact in the value chain, and what sort of transition changes may occur, and how that translates into cost, demand, and competitiveness. Importantly, it should also bring opportunities into view, so not just risks. So consider where demand may shift positively and where innovation or capital allocation can support growth. If we look at what the UK SRS requires, the standard mandates the use of scenario analysis for the purpose of assessing your climate resilience. So while the standard doesn't prescribe specific scenarios or a fixed scope, there are certainly clear expectations. So the analysis must use a diverse range of scenarios, including alignment with global climate agreements. They must also cover both the physical and transition risks and opportunities. And then when scenarios are selected, they have to be done on a reasonable and supportable basis. So clearly defining what rationales are being used. What the standard also requires is that scenario analysis is used in a way that is what they call commensurate with their circumstances of the company. So where practicable, quantitative analysis is strongly preferred, but of course, depending on your exposure to the risks, your available skills, capabilities, and resources, in practice, what they may look like is for a client or a company with lower maturity, you can use qualitative as a starting point, whereas those with higher capability, higher exposure are expected to use quantitative or hybrid approaches. And then, of course, this is expected to shift and evolve over time as you develop your understanding and your capabilities. Now, a key requirement as well is that resilience assessment is mandatory and that scenario analysis must directly inform that assessment. So we'll explore this a bit more in detail in the next slides. One thing to point out here is that while scenario analysis can align with your multi-year strategic planning cycles, the resilience assessment itself must be updated and disclosed annually. So this is a key step in moving from analysis to conclusion. And in practical terms, the exercise has to be credible, of course, documented, explainable, and all your inputs, your scenarios being used, your assumptions, time horizons, all these should be clearly disclosed. And where and if assumptions differ from your financial statements, these have to be explained and clearly justified. So for many organizations, it means strengthening not just your analysis, but also the supporting process behind it. A robust analysis should look beyond just direct operations, so taking a full business model and value chain perspective. So that means thinking not just about your own operations, but also your suppliers, customers, partnerships, and in some cases, investments. And once you take that broader perspective, the questions expand. How is your value chain impacted? How resilient are your key and critical suppliers? And what pass-through costs may there be? Once you layer in the considerations of your policy, technology, market, reputational risks, this shows how it can translate into real financial impacts, both on the downside and upside. So again, not just your costs and your losses, but also opportunities, like what sort of new markets emerge, what are the efficiency gains, and what improved access to capital you may have. And that's really the point, using scenario analysis to link your climate impacts to real business outcomes across your full value chain. So the UK SRS standard makes it very clear that organizations are expected to move toward quantification over time, although this does not necessarily mean starting with full financial modeling if your capabilities don't allow for it. A purely qualitative approach on the left-hand side, however, is unlikely to be sufficient as a long-term endpoint, especially for organizations with greater exposure, capability, or investor scrutiny. So for many companies, a staged approach may be more appropriate, moving from that qualitative towards the quantitative approach. But organizations with the necessary data, resources, may move directly to more advanced quantification from the get-go. Essentially, quantitative analysis is required to the extent practicable, and generally, as you move toward quantification, investor value and decision usefulness also increase. So the standard does allow for certain limitations where impacts are not separately identifiable, where uncertainty might be too high, or where information may not be useful, or if your capabilities are not yet in place. In those instances, you should explain why quantification may not be possible, but still look to provide the qualitative insight. So really the key message is to use an approach that is credible and proportionate to your organization today, but look to enhance the depth and quantification over time where possible. So this is a busy slide, but financial impact and quantification is really where the UK SRS becomes especially demanding. So the standard requires the disclosure of both quantitative and qualitative disclosure. It includes assessing impacts in the current reporting period, as well as anticipated impacts, so across your short, your medium, and your long term. And importantly, how this links to financial planning. So both quantitative and qualitative disclosures are expected, but as mentioned before, where it's not possible, the idea is to explain clearly why and still have financial effects qualitatively described. So there is some flexibility, although there is no option to ignore the financial dimension altogether. So companies must clearly demonstrate that link between risks and your climate performance. So how does that look like in practice? Quantifying climate impact can be approached through a structured sequence. So we've laid down it through 4 high-level steps on this slide. So starting off with a clear risk inventory. So identifying what your climate risks are, if necessary, breaking down them further into subparts and identifying what their triggers are. These risks are then linked to business exposure by mapping those impact pathways. So think about how they affect revenue streams, your assets, your operations, what sort of costs might occur to your business. And then the next step is to quantify those financial impact channels. You do this by assessing the likelihood of the risk, the magnitude of the impact, and then using that together to estimate the expected financial effects. And lastly, stress testing them under severe but plausible scenarios. And then importantly, organizations should also look to define the KPIs and monitoring frameworks that allow you to track and refine these risks over time. The reason this is important is because the SRS really asks companies to demonstrate a clear understanding of the relationship between your exposure of climate and your financial outcome. So moving beyond just disclosure, but really building internal methods that support planning, prioritization, and resilience. So really tying it together, the core question becomes how resilient is the organization's strategy and business model to climate-related changes, impacts, and uncertainties? We've laid down the key considerations and disclosure requirements that are required by UK SRS on this slide. So thinking about things like what are the implications for your company's strategy and business model? What does that suggest about your future positioning? And how you might need to adjust or adapt to these effects, as well as identify what the major areas of uncertainties are and how scenario analysis was used to inform the assessment. In practice, it's about really bringing these elements into a clear, decision-useful resilience narrative that informs business decisions and strategy over time. So moving beyond analysis now and into how climate is really owned and governed, in practice, this looks at governance, so establishing clear accountability and also ensuring the right stakeholders are involved to support the clear decision-making and implementation. So under the SRS, companies have to disclose how the climate risks and opportunities are governed and managed. So a step up from CFD in terms of formality and integration. So what this really looks like is identifying who in the company across the business is responsible, where and how these responsibilities may be formally embedded within governance frameworks. So it's not enough to just assign ownership, but climate needs to be structurally embedded into your governance and decision-making frameworks. You should look to consider as well how climate is considered in major decisions and risk management. So key questions like how are climate issues weighted against your other priorities and what sort of trade-offs may there be? How are climate targets set, overseen, and monitored? And are they linked to your executive performance or remuneration? From a management perspective, thinking about climate reporting controls and procedures, these have to be held to the same amount of rigor, same level of rigor as financial reporting, and also have responsibilities integrated across the organization. So more broadly, it really requires a strategic view of sustainability transformation and clarity on what governance structures are needed to drive the change. And in the medium and even longer term, thinking about what skills, what resources may be needed to drive that change. And then on stakeholder engagement, this slide really just makes the point that implementation cannot sit within one function alone. So of course you have governance board that provides the oversight and management that integrates it into strategy. You have your other functions like finance, risk, and legal that of course play a critical role in embedding it into financial processes and risk frameworks. And sustainability teams coordinate your disclosures and planning. The practical takeaway is basically that it cannot be done on its own. So really thinking about cross-functional integration here. And once you have that ownership in place, the focus really shifts to building what sort of reporting infrastructure is needed to support this. So with that, I'll hand over it back to Julianne, who will take you through how it comes together in practice for data reporting and controls perspective.
Thanks so much. We're now going to take it into how do you actually get into the reporting piece of this. So if you can just go to the next slide, please. So first, just a few things around the data and controls you'll need to consider. First of all, the data needs to be published at the same time as your financial statements. It also needs to cover the same period as your financial statements, so you need to ensure there's an alignment there. For companies, controls should match what you have in place for financial data. Get to know your finance teams if you have not done that already. An additional piece to note around assurance is while the UK SRS is out, the rules around assurance is part of the FCA consultation that ended on March 20th. So we're still waiting the final rules around assurance. However, from a controls perspective, we recommend aligning your processes with what the finance team is already available. You need to know records of who's signed off data, who are the data owners of each piece. You need to flag anomalies and make sure those don't get out. And ideally, this is all being managed via a central location where you can apply those rules. Well, data has a rule in place that it needs 2 levels of sign-off, and you have that collected as you go through the process. If you go to the next slide, please. One thing that we really want to point out is while the UK SRS is new, as Helena pointed out at the beginning, this is not the only jurisdiction that's considering adopting their own version of the IFRS S2. There's a lot to be learned from what's happening under IFRS S2 as you prepare what you're doing. So for example, you can leverage examples from other jurisdictions. So here's an example of the UK SRS requirement, an example of it disclosed under IFRS S2. One market to definitely consider is Australia has already released their own version of a very, very similar standard. Those disclosures are all going to be on the market before UK companies need to get their disclosure. there are details that are different, but there's so much to be gained from like the wider jurisdiction in terms of what they're actually publishing under IFRS S2. We can go to the next slide. Yeah. And then again, how can AI actually do this for you? So AI is gotten very, very strong at pre-drafting and actually even pointing out the gaps within the pre-drafts. So taking the same company that we looked at earlier, BAT, what we did is under question 6.A of the UK SRS, we actually pre-drafted BAT's disclosure against that area. And what you can see in the highlighted text, and there's a few different areas, is again, it will point out within that pre-draft where you need to add clarification. So for example, in this case on the pre-draft, it says that while some aspects of the disclosure is complete, actually the company needs to clarify the frequency of updates for each governance body in a consistent and explicit manner. So again, technology can really help you streamline and make it very, very obvious how the differences land between where the UK SRS is today versus what you have been publishing, and give you, again, a very clear starting point, especially on year one. Considering the previous, as more jurisdictions begin publishing that, it's only going to get better, because if you have multiple jurisdictions worth of disclosure, you can train models on more and more IFRS S2 statements. That makes it even better at actually pre-drafting for you as you go. To the next slide. So back to the Agendi team.
Brilliant, thank you. So the final step, improvement and future planning, matters because UK SRS S2 readiness is definitely not a one-time exercise. So what most companies will need to improve their approach over several reporting cycles, particularly in certain areas such as Scope 3, scenario analysis quantification, finance integration, and also control maturity. The key is to really approach that progression in a very structured and credible way. And it's the logic as well behind the phase approach that we will show here. So companies should consider a phase approach that uses voluntary alignment and stage improvement to build that readiness over time. So here we've really classed it into 3 practical themes. First of all, phased in planning. This really means deciding on what can be delivered now, assessing your gaps, thinking about what may need a longer lead time and preparation, and what sequence of work will produce the strongest improvement in disclosure quality and internal capability. Secondly, progress tracking, of course. That means setting certain milestones, assigning clear and defined ownerships, as well as monitoring your development of your governance, your strategy, your data quality, your methodology, as well as your reporting outputs. And then third, but not last, data collection. So really this looks at strengthening your systems in place, your controls in place, and evidence trails so that the organization can support more rigorous reporting year after year. This is especially important because climate reporting doesn't sit on a delayed timetable separate from finance, and it needs to work alongside the annual reporting cycle. And especially if we think about the likely phase assurance requirements that come in, the evidence and auditability of the information being provided is, of course, becoming more and more important as well. So really, a phased approach isn't about lowering ambition. It's really about building a really reliable and defensible response. And so with that, I can hand it back to Helena, who can close with our main takeaways from today.
Brilliant. Thank you so much, Jean-Marie and Julianne. So on to the takeaways, and then we've got some great questions rolling in. We can move on to those afterwards. But first and foremost, obviously, one of the key takeaways here is that the UK SRS should be closely aligned with your financial planning and reporting. So this is real integration in timing, processes, and as Julianne mentioned, governance. The regulatory timeline, it's becoming clearer. We don't quite have finalisation yet. The FCA consultation closed on the 20th of March with proposed mandatory application of S2 for listed companies from 2027, keeping in mind that 1-year transitional relief on Scope 3. We've covered consistently throughout this webinar, which is the goal for these disclosures is to be decision useful with clear documentation, data, assumptions, methodologies, And as Julianne mentioned, the same level of rigor as your financial reporting. So even if those assurance expectations don't roll in as expected in the beginning, do keep in mind that that level of quality is expected as we move towards the same level of rigor. And this is especially important when we consider the financial quantification of climate impacts. And it's not just risk focus, it's also the opportunities. We've covered in depth that a structured gap analysis and phased roadmap are essential. Keep in mind that you do need to consider some of those overarching concepts within the broader UK SRS S1. So don't move it aside with the 2-year transitional relief. Really think about those key decisions and how they'll filter through to your ongoing reporting. Having this very clear disclosure roadmap in terms of your actions and your disclosures and getting that preparation, getting those controls up to date is absolutely essential. As you build capacity, you build maturity in terms of all of those levels of data and controls. And Yunmiri covered in depth the enhanced expectations around scenario analysis. So moving away from the qualitative scenario analysis within the current disclosure requirements with the increasing level of quantitative insights over time. And of course, when you're thinking about breaking down and disclosing on those financial impacts, it's all about looking at those impact pathways and breaking those down as granular as possible and trying to price. I guess it's a little bit of bottom up and top down at the same time. And then finally, UK SRS should be seen as a strategic framework. The goal of this is to bring forward clear investor useful disclosures, strengthening your governance processes controls as part of the broader UK strategy and sustainability transformation. With that, we've got a couple of minutes to answer a couple of questions. One of the ones that we had roll in at the beginning of the webinar was whether the UK SRS is expected to replace the current SECA reporting, so the streamlined energy and carbon reporting. And that's a tricky one. We don't quite know the answer yet. Our expectation is it is likely to be replaced. SECA, the UK SRS will replace, although the roadmap for this transition, it's not yet fully clear. So there's a proposal expected within Q2 for the non-listed companies, and we do expect that this point will be addressed around it. The main consideration here is that SECA relates to additional expectations on energy use, intensity metrics, and that currently feeds into the UK's energy efficiency and emissions monitoring framework. So how that all comes together and whether or not some of those elements will feed into the UK SRS will be something that needs to be figured out in the coming months. We have probably time for a couple more questions, so do keep them rolling in. Julianne, I might hand this one over to you because it was your comment in the beginning. We've got a question here that says, as our sustainability year is a calendar year, but their financial statements are on a 52 weeks, they're always a few days out within their reports. Is it okay to have this few days out, or should they be looking at changing reporting periods?
Yeah, thanks so much for that question. So I actually had time to check the exact UK SRS code that answers this. So that is okay. And if you want to check exactly what's required around that, so the rules around how you need to align your reporting to your financial statements is defined under the UK SRS 1. And there's a specific area, bullet point 65, if you're looking at the disclosure that goes into this case, and they say that you are allowed to do a 52-week sustainability data year around a calendar year for your financial data. There's some specific sub requirements that you need to communicate within your disclosure as to why that's the choice. As long as you hit those sub requirements, that's going to be okay for you.
Brilliant. Thank you so much, Julianne. I've got another question here, and I'll pass this one over to you, Yunmiri. How do we determine financial, material, climate risks and opportunities? What's the process there?
Sorry, I was trying to find the unmute button. Thank you for the question. I think a good starting point is really to identify your full range of climate risk and opportunities, right? Across both your physical and transition categories and and as I mentioned, across your full value chain as well. And then once you have your full set of climate risk and opportunities from there, it's really about focusing and assessing on which of these could have a meaningful financial impact. So impact on your financial performance or position. So again, SRS S1 and S2 really focuses on the financial materiality perspective. So thinking about the likelihood and severity of the impact and over which time horizon that may materialize. And then lastly, of course, linking that to how it affects key business drivers. So revenue, costs, asset, capital allocation. And then lastly, of course, again, linking it back to the scenario analysis piece, how it plays a role in stress testing these impacts under the future conditions will help you really prioritize what is most material there.
Brilliant, thank you. And we've got another question coming. I'll give this one to you, Julianne. What's the view on location of reporting? We've covered timing, but do we expect the UK SRS reporting to ultimately sit in the annual report or separate reporting looking like an option?
Yeah, so the expectation is that that will likely be defined in detail by the FCA. So it's hard to know exactly what will happen there, but I would expect it to happen within the same annual report, unless Agendi your views different on that. But we think it will follow what's going on under the CSRD rules. That's what we've seen from other jurisdictions where companies are farther ahead and have already begun to publish IFRS aligned statements. So that is the most likely scenario.
Brilliant. And I think we would agree with that too. It's a little bit of wait and see, but the expectation is that it would sit within the mainstream reporting. Yin Miri, I've got a question coming in terms of scenario analysis. It's quite a brief one. They're saying that their scenario analysis is quite high level. Is this still okay?
Yes. Yes, I guess the short answer is yes. A high-level analysis can be a good starting point, but again, the SRS really needs it to become more decision useful for investors and more business linked. So that really means moving beyond just qualitative narratives and insights and really show how your scenario can translate into impacts on your strategy and also value chain. So highly complex modeling isn't really necessary if you don't really have the resources and capabilities to do so. So again, really thinking about the linkage between what resource capabilities do you have, how highly exposed are you to those climate risks, and then assessing what is practicable and allowable for your circumstances. So it's a good starting point, but the idea that they stress on is really built toward more detailed quantification over time.
Brilliant. I think we've got time for one more question. I'm going to throw it to both of you because I'm sure you have very varied perspectives. Julianne, I'll hand it to you first. What should organizations look at prioritizing first in relation to UK SRS S2?
So the standards are already out. So while we are waiting on the FCA results from the consultation, you do actually have a final look at the drafts. So there's no reason why organizations cannot start preparing and aligning their data to the UK SRS now. Again, something we've learned from other pieces of regulation is the organizations that begin early, they start restructuring their data aligned to the regulation, ultimately have the easier time. So for a long time, we were waiting for the drafts. Those drafts are now finalized. They got published in February. You can start working off them. There is still an unknown on the FCA and timeline there, but one big piece of the puzzle is actually solved at this point. So get started, just begin making progress is my tip.
Brilliant. And Yinri, I know you covered a lot of scenario analysis, financial quantification. What would you recommend in terms of prioritization in preparation?
Yeah, I'm echoing what Julianne said as well. I think really we now have the final standards. A very practical approach is to first do that gap analysis, compare what you have. A lot of organizations probably already have current climate disclosures under current UK CFD. So assess those gaps. What is additionally required by UK SRS, and identifying those gaps will really allow you to identify where to prioritize and focus on. But if I were to pick a few, I really think scenario analysis, quantification, that piece that I covered is really one of the most material areas to focus on, and linking to financial impacts, be it qualitative or quantitative piece. And also another side is the cross-functional integration, so really involving not just sustainability departments, but also your finance, your risk, your legal teams, and making sure there is ownership there.
Brilliant. Thank you so much. We are at time. There's a couple more questions. We're happy to get to those offline. I want to thank you again for your participation. Thank you to Yunmiri, Julian, and we'll provide our contact details in the follow-up. More than happy to answer any questions offline. And thank you very much for your time today.